Mike, this is a scenario where we've been talking so much about this notion that the markets may or may not be valued fairly based upon the fundamentals, but it sure looks like the fundamentals may actually be justifying the levels that we're at.
Absolutely. No, I think when you're looking at levels like this, 5,000, it's certainly a big number. Mike Santoli mentioned 4,000 a minute ago. It is a moment to reflect. We've had a huge move over the past year, and the markets kind of keep running. Are we going to cross 5,000? It could be. There's certainly a lot of things to make people reflect as you're getting close to that big level. Is it behavioral? Sort of, in some ways, it's just a number. It's kind of meaningless. It really, whether it's 49.99 or above, doesn't matter. Some technicals there for sure. I think we are hitting some technical levels. That's some stuff to watch. But I would agree with you. I think earnings, that is the real kind of long-term driver. That's, I think, what we focus on. I think what long-term investors would be more interested in. And that brings us back. How fast are earnings going to grow this year? Is it 5%? Is it 10% or more? Looks pretty good. It's more than nothing. That's a good thing. And so as earnings continue to grow, unless we see some big nasty recession or down cycle, earnings are going to grow. Stocks are going to chase those earnings, and we're going to continue moving. Likely well beyond 5,000. I don't know if it's today, tomorrow. As long as earnings grow, we're going to again move exceedingly beyond that at some point, probably this year.
So Mike, there are a lot of variables here, but interest rates are probably front and center for this. They not only influence valuations, but they influence the fundamentals behind how profits can flow through for corporations. Just how important is the outlook for the Fed to this earnings growth narrative in the markets right now?
It's critical for sure. And I think in some ways, we saw a very interesting test of this last week. So Jay Powell comes out, pours cold water on everyone's hope for near-term rate cuts. What happens to markets? A few days later, we're still chugging along nicely. So I think in the short term, we may be beyond interest rates as a downside risk factor for markets. Certainly that's going to come back. We're going to have another Fed meeting. If Jay Powell does this again, if we get another kind of slap on the wrist, that could certainly be a problem. But investors are okay. We're seeing macros looking pretty good. Inflation's coming down. Jobs are good. Companies are growing earnings. That's enough. So investors are comfortable with that. Even if, Jay Powell dangling the carrot out there for rate cuts, it's a little bit further out. That's okay with markets. And I think we're going to continue to see some upside here.
In the end, Mike Santoli, I guess I've learned over the years that earnings growth is really the fundamental driver of stock market performance. Earnings growth plus dividend yield plus a speculative premium. That's your return there. So far, the fourth quarter earnings numbers have been pretty good. Can it continue this year? What are you thinking?
Yeah, they've been reasonably good. I mean, I think your beat rates are pretty much in the zone of what you have come to expect. It does seem as if we have the makings of it. I keep pointing out, we entered this year at a something like 6% nominal GDP growth pace. The current tracking for the first quarter seems like another above trend GDP growth quarter, at least in real GDP. Inflation's still 2 to 3% at minimum. So you have the makings of earnings being good. The other piece of it, of course, is that just as the market performance has been quite top heavy, a lot of the impetus for earnings growth in aggregate has been coming from these massive secularly growing companies. So you've been able to rely on that for a while. The rest of the market struggling with some sales growth. Margins seem like they're getting preserved. So you have the makings of at least tilting higher in terms of earnings growth. And when that's the case, and when the Fed is at least not tightening, and so far rates remain somewhat benign on the yield levels in the market, it seems like usually the market can stay supported, I'll say at minimum.
Mike, let me ask you about the stock that I think so much has determined the performance of the S&P 500 in the last year, and that is Nvidia. Let me turn this to Mike Bailey, if I might. What if Nvidia, Mike Bailey, disappoints when it reports on February 22nd?
That's a big deal for sure. I mean, I would agree with you. It's a mega cap now, Magnificent Seven. It's really been a big driver. It's sort of the poster child of AI. So if you think AI works, Nvidia, that's really concentrating a lot of that value. If there is some disappointment, we get earnings in a few weeks. That is going to sort of end earnings season on a really bad note. So the question is that going to happen? It seems like some of the tea leaves at this point look fairly favorable. Companies that are out there spending a ton of money on these chips, they're still spending a ton of money. They're spending even more money. So I think the trends look pretty good for Nvidia, but absolutely this will be a pretty big catalyst. As kind of a side note, for what it's worth, the other sort of AI-related company, ARM Holdings, you mentioned up a lot. not in the S&P 500. If it were, we'd probably be past 5,000 today. So kind of interested.
True.
All right, Mike Bailey, if it's not Nvidia, you've got your eyes on there. If it's not Nvidia, then what are the investments to make right now with the stock market hovering at this kind of 5,000 level?
So I think in some ways you can sort of have your cake and eat it too. You can participate in some of these high growth companies. But if there is any type of correction, I think you can hedge yourself. So Google is an interesting company. A lot of growth, not quite the upside as some of the other Magnificent Seven over the last few weeks. However, it's really the only sort of tech mega cap that's trading below the market in terms of valuation. So a lot of durable growth there. You're not seeing a boom bust cycle like in some ways you might be seeing with Meta. So more durable growth, very nice valuation below the market. That's a little bit more comfortable way to play that growth theme without really kind of sticking your neck out with something that's perhaps more of a boom bust cycle.
All right, Mike and Mike, thank you very much. Bailey and Santoli, we appreciate it.